We've had quite a dramatic week for markets this week, not necessarily for the equity market, but more for currencies and commodities, where I'd be focusing the attention today. Let's just look at the first chart, which is the CRB Index, and this is representing a basket of currencies and commodities. And literally just in this last week, it's been a very, very sharp correction, almost one would refer to as a crash in prices. There's obviously been a hell of a lot of speculative money going into these commodities and treating them to some extent as a bit of a one-way bet. And I suspect that there has been margin calls on the way down, which has accentuated that particular move. But if we just sort of pull up some other charts, just to give a flavour of the extent of the decline. This is the chart of silver, which has been a real speculative sort of build-up here, and we've seen there a move down from sort of 46, 47 down to 35, so a very, very sharp correction. On to copper, which obviously is a bit more for the real world. It's clearly been building a little bit of a sort of head around the 450 level, and we can see there a sort of fairly meaningful correction down to 400. The other chart that I think will be pleasing to motorists is what's happening to the oil price. This has been a dramatic fall in pricing here, and is actually continuing on Friday morning. So as I say, we could be seeing a print of around 96, 97. In the oil price, and this is all being driven by concerns over demand, and the oil is quite sensitive to demand. For the large extent, there has been some Middle Eastern issues that drove that last speculative run in oil, but a very, very sharp reversal, which again I suspect has been accentuated by margin calls for the more speculative hot money at the moment. But let's see if that comes to the price of the pumps in the course of the next few weeks. So these movements down in the whole of the commodity space is having some impact on the FTSE 100. This chart here shows that again, having looked at that 6,100 level there, which has now been really a barrier to this market for a period of 4 to 5 months, having failed to break through the 6,100, we've seen that very sharp reversal. And because London is very resource heavy, it does house Rio Tinto, Billiton, BP and Shell. We tend to get hit much harder than, say, US markets that tend to be more industrial and technology weighted than our own markets. So as I say, that is the reason for the FTSE's decline. Moving to currencies, I want to just pick up on the major currencies and sort of movements that we are seeing at the moment. A few weeks back I highlighted the yen as a currency to watch. You may recall this dip in mid-March that resulted in the G7 moving into the currency markets and giving some support. To some extent you need to turn this chart on its head, because whilst it shows decline, this is the dollar versus the yen, so this decline here shows yen strength. And this move here around the time of the earthquake, the concern of course was a lot of yen, money heading back into Japan for the remedial action post the earthquake. So this support from G7 caused yen weakness, dollar strength, which was temporary but sharp. But actually ever since, what we've seen is a continued decline, and we're getting down not far away from levels where the question will be asked again, will the G7 step in? So I'm myself going to sort of keep quite a close eye on that, as to see, it could be in the next week or two, if we continue to see this sort of trend continuing, whether we're going to see intervention in the yen currency markets again. This has been a trade which will impact on equity markets potentially positively if the G7 do step in on that. Let's also look at the dollar, because the dollar against a basket of currencies has continued to be weak. There has been a small reversal here, and that reversal has taken place because the euro sold off quite aggressively roughly post the ECB comments on interest rates. I suspect there was money in the euro market for potentially another rate increase from Trichet. They didn't get that, or they certainly didn't get the comments that we'll have a rate rise next month as yet. So there was a sell-off, and this also was sold off on the basis of some German factory orders that were remarkably weak, down 4% month on month. The forecast was down by 0.5%. So maybe some early indications here that demand, even in some of those high-performing markets like Germany at the moment, are coming off. Certainly in the UK, we're seeing a lot of economic indicators turning quite sharply lower. Indeed, we've heard reference this week to potentially house prices coming down. And so there are demand concerns. That is what's impacting on commodities. That is, in a sense, impacting the currency markets. And the London FTSE 100, being resource-based, has obviously suffered a fall. I think it could come back a little bit further if this trend accentuated, but just keep an eye on the yen-dollar ratio and see whether the G7 re-enter the market if it were to hit those levels. They supported it last time. And just finishing on one final sector that again has aided the FTSE's fall this week has been the banking stocks. Lloyds reported results. It is their third profit warning now, and you can see there that share price reacted in a negative way. It was a shock. They have taken a much larger provision on payment protection insurance around into loans, and that share price has come back to a new low. The banking experts are telling us that the tangible book value on this bank is now just above this share price in the sort of mid-50s to upper 50s at the level. And I would, from a trading stance, say that if this stock does feature below 50 pence in the course of the next few days, on the back of these results, that would be, for me, a compelling buy opportunity. There is a strategy day that is due in June. This new chief executive, I think, has cleansed the business of a lot of cost and, to some extent, over-provided. I'd like to think the strategy day would be a more upbeat tone about how he's going to rebuild the bank. But the share price is below tangible book value, which I think is very unusual for a clean bank to be priced at that level.